Welcome to Phillip Highlights. I'm Emilia, and I will be serving you the latest news of the week. Your news, our business. Fed's preferred inflation gauge accelerates, adding pressure for more rate hikes. The Personal Consumption Expenditures Price Index rose 5.4% from a year earlier, and core metric was up 4.7%, both marking pickups after several months of declines. Consumer spending adjusted for prices jumped 1.1% from the prior month, the most in nearly 2 years after consecutive declines. Given the still resilient job market and higher inflation numbers, we expect the Fed will continue to hike rates at the upcoming FOMC meetings to ensure inflation will continue on a disinflationary trend. Fresh data from the Eurozone are set to highlight why European Central Bank officials are hanging on to their hawkish tone even as the region's worst ever spike in prices recedes. Economists polled by Bloomberg reckon headline inflation is for the fourth month in February after warm winter weather sent natural gas prices tumbling. But the core gauge that strips out such volatile items will probably hold at a record 5.3%, with its stickiness resembling the worrying picture in the US. We expect additional rate hikes by the ECB to contain inflation pressures and remain cautious that rising borrowing costs would constrain the demand outlook in Europe. China's economy rebounded in February after the long holiday, although early indicators point to an uneven recovery with strong consumption following the scrapping of COVID rules but lagging industrial activity. That is according to Bloomberg's aggregate index of 8 early indicators, which showed growth momentum this month maintained the pace seen in January, with the overall gauge staying unchanged at 4. Nevertheless, we expect the overall economy likely to rebound this year as production and people's daily life are normalizing rapidly, and the return of Chinese economy shall inject higher demand on global trade activities. Malaysia Prime Minister Anwar Ibrahim unveiled an expansionary 2023 budget of 388.1 billion ringgit on 24th of February, the largest in the country's history. The government is expecting GDP growth for 2023 at 4.5% year-on-year, while expecting the budget deficit to narrow further to 5%, riding along a stronger than expected economy last year. Neither prosperity tax nor GST was announced, but tax cuts were welcome instead. There have also been concerns about government debts, but we believe that it is likely manageable. While this year is expected to be more favorable for investments than the previous year, it is important to stay watchful for any market volatility. PhillipCapital Malaysia provides a comprehensive list of products including discretionary private managed accounts and unit trusts that are offered to retail investors, high net worth individuals, corporations, and institutions. Whether you want to DIY, seek for advice, or let the expertise fully handle your portfolio, our platform can cater to your needs and preferred way to achieve your financial goals. That's all for today. Stay tuned for the next Phillip Highlights. This update is brought to you by PhillipCapital, your partner in finance.